Hi, this is Adam and Tay from the Learn, Invest, Grow show. And this is an interesting topic. Usually we generally talk about real estate investments. It may be investment loans, it may be investing in equity and single family rentals, multifamily. But this is something different. This is something that we really want to help answer our audience question regarding buying a house to live in. And look, we're living in a really unique time in history. We've never actually seen this type of time where we're coming out of a pandemic, hopefully. Now we have the vaccines rolling out. But COVID really made things interesting for us where the market shut down and all of a sudden it became a super seller's market, right? We're seeing prices just going through the roof, bidding wars, record low interest rates. And the question is, if you're a buyer looking to buy a house, what type of loan should you take out, right? And what's interesting is Tay over here, he was running numbers. And he's like, this is a really good topic. And I have a lot of questions from my colleagues and friends, and I was running numbers, and you know what? Let's create a video. And I was like, let's do it.
Yeah.
So Tay, let's see what really the differences between like a 15 and a 30 year. And I remember we were having that conversation about like why you favor the 30-year versus a 15.
Yeah.
Right? I mean, the concept is, well, if I take a 15-year mortgage, I could, I'll have bigger payments, but the house will be paid off in 15 years. But what about the 30-year? There's more flexibility, which you mentioned.
Yeah, exactly. So, I mean, we're gonna run the number right after this one, but I think it's important for us to kind of talk about the distinction between 15-year and 30-year in terms of pros and cons. So yeah, why don't we look at pros for 15-year first, right? So as Adam, you mentioned, obviously you're actually given a lower interest rate because from the lender's perspective is less risk because over the shorter period of time. So they actually offer a lower interest rate, which is good for a borrower. And then secondly, you can actually build home equity a lot faster by paying more a principal and interest, right? And then obviously you are completed your payoff in 15 years compared to 30 years. So you can be debt free in 15 years. But on the other hand, there's a cons, right? Almost like a flip side of the pros. So you actually pay a higher monthly payment because you have to pay off the entire mortgage in 15 years. So which translates into a less cash flow per month. And obviously with you actually qualify for the smaller loan in size, obviously. And the another big cons I like to highlight is you actually have more money really tied up in property.
That's actually a big one.
Yeah.
And we spoke about that.
Yeah.
Well, why tie up all your equity in a property when you could actually use that money and make a return on that money?
Yeah, exactly.
That's a whole other episode we could talk about.
Yeah. Because from the investor perspective, you want to minimize idle cash right in the property. Okay, why don't we jump over to 30-year pros, right? So obviously the first one is you have a lower monthly payment. So which means you have a less financial obligation. So let's say we actually going through the pandemic right now. Is when pandemic hit, people may lose job, and then there could be another medical bill unexpectedly. So with the lower the financial obligation, you have a more leeway. To get through the type of unexpected event. So which could be good things. It can have a more flexibility. But secondly, a flexibility here. So I think this is a really big pros of a 30-year mortgage. So if you have a discipline, you can actually invest the difference between the two, right? You pay more and then you pay less. So you can choose to invest the difference, or you can even pay off early as if you were actually holding the 15-year mortgage. If you have a bonus coming in, for example, you can just decide to pay off the principal more so that down the road you can pay less amount of interest. So this is, I think, a great pro, in my opinion.
I agree. Actually, I agree. The flexibility, when I spoke with you, I was like, actually, that makes a lot of sense to take out a 30-year And if you want to save on the cost, on the interest, just make larger payments. And also you're gonna have, and then you'll pay it down faster. Whereas at 15, right. You don't.
You have no choice. You have to really,
that's it.
Yeah, pay it. Yeah, right.
You know.
And the cons, you have somewhat like kind of this is stating the obvious, like a higher interest rate, and obviously it takes a longer time to build up equity and longer to pay off. And I mean, we put down this qualifying for a larger loan because you can afford to buy a house that are more expensive, but on the other hand, like you may fall into the trap of over leveraging yourself. So which is a huge no-no in this lower interest environment. And because with the more mortgage amount you can borrow, you tend to buy a bigger house. So which can like result in the higher maintenance cost, like property tax and upkeep costs and utility bill. So I mean, this is a little bit not really little bit subtle, but you may want to take into consideration.
Well, that's something that people, when you buy a house, that's, you know, you're like, oh, I'm renting, but when you buy a house, that's the maintenance. That's all on you. There's no landlord to say, hey, you need to fix this. It's all on you.
Yeah.
But that's actually really good stuff.
You know. Now that we talk about the pros and cons, so why don't we take a deep dive into the underlying calculation?
The numbers.
Yeah, numbers, right?
Let's dive deep into the numbers.
Okay.
Okay, so now we're going to dive deep down into the numbers. Hey, let's explain the difference between the 15-year and the 30-year. Let's look at the numbers.
Okay, so let me walk you through like real quick some of the high-level information. So in this scenario, we're just drawing $500,000 a mortgage loan, and then the 15-year. When we check the interest rate, like from the Chase, is a 2.125% interest and almost a 2.9% interest. And so your monthly payment is a little bit over $3K, and here is a little bit over $2K. So overall, over the 15-year of a mortgage period, you'll end up paying $84K in terms of interest, as opposed to $246K in interest. So on the face of it, you're actually seems better off because you pay actually $162,000 less in terms of
it's a savings.
interest.
It's a big savings.
Yeah, right. But that's really under the assumption that you just make a payment and do nothing, right? So actually you get a kind of guaranteed return of a 2.125% by paying this off. So why don't we kind of take a hypothetical situation where we actually invest this monthly payment after this person pays off mortgage altogether. So from year 15, they start investing this monthly payment, right? At the 8% return after inflation, because S&P historically gives you around like 7 to 8%. So just 8% could be like a reasonable term, we believe. And then at year 30, what do we get out of this investment? So they obviously have a paid off home, right? And then comes out with $1.1 million approximately. And then, why don't we look at the 30-year mortgage holder? So, but they can actually, instead of like investing in year 15, because they actually, their monthly payment is less than 15-year by $1,000 and $172. So they can actually invest this difference from inception, right? And then if they keep investing and then reinvesting at the same rate.
They're investing with the savings, and hopefully they're keeping up with other basically similar investments that make 8%.
Yeah, 8%, right.
So that's like the standard, that's the benchmark we're looking for.
Right.
So 8%, that's what they're...
Yeah, at year 30 with the paid home and then 1.7 million. So
wow.
Actually this one is almost like 600K, more than 600K is more money. So from the financial standpoint of view, so we believed going for 30-year may make sense. Obviously, some people really prefer to have a peace of mind, so that they'll prefer to pay off that altogether. Then 15-year could be the way to go. But if you think about your retirement and then how much money you can actually get out of after 30 years, we believe this is the...
So one thing to keep in mind is it depends upon the demographic, right? If you're a young person, let's say you're a millennial, those are the biggest home buyers now, are millennials, right? You're going to think long term, 30 years, right? So this would probably be the better option because you want to be able to spread out your payments, save money, and eventually you'll own it in 30 years. But guess what? That savings, you can actually invest it.
Yeah, right.
And build a nice nest egg for yourself.
And also this tactic requires self-discipline, right? So you gotta control your budget, and you always if they instead spend this money elsewhere, then this tactic doesn't work, right?
If you're looking at, let's call it conservative investment, something that's more conservative, that you could reach that 7-8%. That's a smart way to go.
Yeah.
This is the way to go. 30 years, spread it out.
Yeah, especially with such a record low interest rate, right? Because you can easily beat this interest rate, right? And also one thing we like to highlight is that this is not really because you can deduct mortgage interest, right? On the loan up to 750K. So since in this example you draw only 500K, you can actually deduct the entire interest. If you choose to itemize the itemized.
But those things could change because I know in New Jersey they changed the law that actually hurt the luxury market. But there are benefits, tax benefits where you could deduct interest, but I wouldn't. We don't have a crystal ball what's going to happen in the future.
Yeah, right. But
things could change.
Yeah. And also with this option, you actually lock in the amount of money you borrow today's dollar term, right? And then you can make the inflation work in your favor with the 30 year because obviously because of time value of money, $1 today is worth less tomorrow, and then 30 years.
That's a good point. Inflation is a concern.
Yeah.
Going back to the difference, right? If you're a young millennial, right, that's typically that's the largest buyer pool, right? You're looking for your forever home. This is a very unique time, as I mentioned, where you have a decision to make. The what type of loan you're gonna take. This is the biggest financial decision you're going to make for most people, at least. And the question is, what is the decision? What is the right thing to do? And Tay is really breaking it down. Really, that's incredible what you're doing. Say, hey, look, you have more flexibility with the 30 year, and you're saving on your monthly payments because you're spreading it out. So you have a savings, and you can take that money and invest, and hopefully in something that meets that benchmark that we're looking at, the 7-8%. And then you're going to have a nice return on your money of that 1.7 figure over there.
Yeah.
Key takeaways, okay? We shared a lot of great information with you, and we just want to highlight a few things. The key things that are very important that we actually pay attention to is the savings, right? Tay, you want to explain more about that?
Yeah, so many people are very fixated on the interest payment in totality. So obviously 15-year mortgage, you pay a lot less by this amount in this scenario. But we would like to encourage you to think beyond this only the total interest paid. So as we demonstrated, if you actually are disciplined enough to invest the difference, you'll actually come out ahead with a 30-year mortgage by investing more conservative investment vehicle, right? So that's what I like you to really get. That's what we like you to understand, like a difference between the two, just beyond interest amount alone.
Look, at the end of the day, people, you have to do what's best for you. What I would do, what Tay would do as investors, yes, will we own a home? Absolutely. But we're going to think about what can we do with that money as opportunity cost. We're making larger payments to pay down a house, but that's not making any money for me. Why do I want to pay it all down? Right? What's my return on my money when the house is nothing? But if I could take that savings and invest it at a benchmark making that 7-8%. That is positive leverage. We're talking about, that's arbitrage. That's how the banks make money.
Yeah, and then they're taking advantage of a compound interest.
Exactly. So look, you know, that's the biggest takeaway that I could see right now. Yes, you have the tax, you have the deductions, but that, you know, really and really want to think about that. And if you need help with talk about investments, we could go into that separately from here. Where to, you know, where we invest at least. So we're not investment advisors. We don't give advice. I mean, we can tell you what we're doing with our own monies. But in terms of you know, what would I choose? I would choose this way. It has more flexibility. I could either, you know, I could pay it down faster if I want, save that interest. You know, yeah, I'll have a higher interest rate. It's not a big difference though.
Yeah, right. Yeah.
You know, or if I want, I could keep that savings and invest it, or I can put it away if I want. But I'll take more cash flow any day than have to make bigger payments.
Right.
That's me.
Yeah, I'm 1% with you. Yeah.
Thank you, everybody. Like, share, smash that like button, share this with your friends. If you have questions, comment, make a comment down below. And until next time, happy investing.
investing. Yeah.